Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And finally, the last item here has to do with implied volatility. All right, and implied volatility, as you probably know, this is an item specific to options trading, and we are selling two at-the-money options. And when you do that, you are making a bet on volatility. You're saying that you think volatility is going to decline. Or at worst, it's going to stay right where it is. All right? And so if you're putting on a trade like this, you better be expecting that. Right? You don't want to be expecting the opposite, because then that trade would not be ideal for that scenario. Now, I think what you probably have gathered by now is that there is no ideal strategy for every event in the market, all the time. You need to understand the strategy so that you can apply it under ideal conditions. Okay, that's really what you're trying to do. And we're going to get into that a little bit more. But just keep in mind, you want volatility to be either declining or static, meaning you want to stay the same. Now, that usually happens under trending markets, when markets are trending up. But remember that just because that means that's good for volatility, well, that's bad for this first item here, that you want the underlying to be range-bound. Okay? So you need to get all these things happening together in order to really be successful in this particular trade. Okay, so now I've given you, on this slide here, I'm saying, okay, what are the optimal conditions? Well, that's all well and good, but how do I find out about optimal conditions? How do I analyze that further? How do I figure out how to put this into action and make this into an actual trade for myself? Well, I use some tools to help me. And the first tool that I use is our probability calculator, because this provides me some information on the likelihood of my success, as well as standard deviation. Okay, so there are some statistics involved, but you don't need to do the math because we'll do it for you. And I'll get into an explanation of what the numbers mean in just a moment. Okay, so I'm going to just skip over the explanation here because you're free to read it, but it may just be overcomplicating matters. That's going to help me define what I think is the expected range of an underlying security. Now, technical analysis, when I layer that right on top, that will further help me get an understanding of what my expectations are for price movement in the underlying. Okay? And so we're talking about analyzing charts, maybe you're looking at trends, maybe you're examining the momentum that's going on. Whatever it is that helps you determine what you think is going to help you get a handle on the estimated range of the security, that's what you're going to be looking for here. And finally, as I mentioned before, implied volatility is an important factor to this trade, so you should also be analyzing implied volatility and coming up with an expectation. Right? Remember I said if you are selling two at-the-money options, you should be expecting volatility to go down or stay the same. And if you don't expect that, then that is not the right trade for right now. But how do you come up with that idea? Well, you basically look at the volatility of where it's been in the past for the underlying options, and you see, okay, where it is now, and you make some type of estimation about where you think it will be between now and expiration, because that's when you'll be in the trade. And I go into an in-depth explanation in a past ISC webinar that I did, and that was called Improving Your Odds When Trading FX Options. So I invite you to check that out as well, and you can find that along with all the other archives that the ISC has made available from all their great speakers. All right, and just keep in mind though, all this stuff that I'm talking about here, all these tools we give you for free at TradeKing. So please come and check them out, use them, and help us, allow us to help you make more informed trading decisions. All right, so here's a screenshot of our probability calculator. And what I did here, this is a little different than what I did with the Condor trade in the past webinar. Okay, this one's a little bit different. Similar approach, but a little bit different. So let's talk a little bit about what standard deviation means so that you guys can get that concept down. What I do here is I would put in the symbol that I'm trading. I would then hit go, and it would populate these fields for me. I would then change this drop down to the expiration of the options that I'm using. In this case, it was June, which was 51 days to expiration at the time. And in doing that, it will give me the numbers down on the bottom here. Okay? And you can see there's a -1 over here, and there's a +1 over here. These numbers are approximately 670 and 790. What those numbers mean in English is this. This says that the underlying, which is currently at 732 or 734 from the chains, right? So on the screen it's 732. With the underlying at 732, there is a 68% chance that the underlying will range from 670 to 790 or 673 to 789 between now and 51 days from now, which was June expiration at the time. Okay, so let me say that again. The first standard deviation says that we expect the range of this security, XYZ, to be between 673 and 789 over the next 51 days. We say with 68% probability, and it's currently trading at 732. All right, so we think it'll fluctuate between 732 all the way down to 673 and all the way up to 789 between now and expiration. Okay, and what that tells me is we're focused on expiration, right? So if I know what the boundaries are, or what the boundaries are expected to be, which is 670 and 790, then I want to create a trade and structure a trade that's going to give me a P&L graph that is aligned with those expectations. That's what we're saying here. All right, now, the thing is, though, this is a guide, right? And so when I did that, the trade that it gave me had so much risk that I just did not think it was worth even showing you. Okay, this type of approach is much better suited to the Condor strategy that I showed you last time, but I had to massage it for the butterfly strategy. So what I did was I constructed the trade the way that I told you that I did, because it gave me a better risk-reward idea than if I had used the standard deviation here to guide me in my strike selection for the butterfly. So what it came out with was the break-even points came up with 690 and 770 for the trade that I already went over, which was buying the 650 puts, selling the 730 calls and puts, and buying the 810 calls, right? So the break-even for that specific trade, I then entered into these fields up here, and that was 690 and 770. When I did that, it then populated this row of numbers here, okay? And the middle number is what I'm going to focus on, and that says 51%. So this says finishing between the target prices. The target prices were the break-even amounts that I put in, and it says that there's a 50% chance that the underlying is going to finish between my break-even points, between at expiration. Okay? All right? So just keep that in mind. Okay? So this says there's 51% chance that I'm going to make money in this trade. Because that's what I said earlier, is that the way I make money in this trade is that the underlying needs to be between the break-even points. Well, what is the likelihood that the underlying will be between the break-even points? Well, that likelihood is 51%. Okay, and this is where you start to see the pieces of what I call the three-legged stool. All right? And you know what happens if your three-legged stool becomes a two-legged stool, right? You fall over. So you need all three items to stay balanced. And those three items are risk, reward, and the probability of either of those events happening. Okay, and that's how you need to approach options trading and how to apply a certain strategy under certain conditions and when to use one versus another. It's all a judgment call, but if you know how to balance the items against each other, then you will make better decisions. All right, so let's continue here. And I just wanted to show a sample volatility chart that can help you when you're doing your volatility analysis. This is on EUI. And when we were looking at the Condor trade last time, it was the implied volatility, which is the yellow line here, was around 14%. Since then, it's now down to about 12% right here. So if we were just looking at volatility alone, that was beneficial to the Condor trade that we were considering last time. Okay, so if I chart the trade that I mentioned earlier for this wide butterfly, this is what it would look like. And I think you could see why it's called wide, right? Because you have a long space between the max loss points, okay? Just so everyone understands, this dotted line, the horizontal dotted line, is the zero line. Anything north of the zero line, underneath this area of the triangle, that's a profit. Anything below the zero line outside of there, so on this side here, or on this side here, that is a loss. The maximum gain we can have in this trade is close to $40 per option contract, so that's actually $40,000 for a 10-lot trade, for 10 butterflies. But it is also potentially a loss of $40 per trade, or $40,000 for a 10-lot butterfly spread. So as I mentioned, I used the probability calculator as a guide for strike selection, and this is just a recap of that. Here are the numbers to what the amounts actually come out to, and it comes out to a $39.60 credit before commissions, and the loss would be $40.40 per option before commissions as well. So let's just call it 40 and 40, okay? So you can make a maximum of close to $40 per contract, and you can lose a maximum of $40 per contract. All right. Just to reiterate, the short strikes are the 730, and that's what is causing this peak here up at 40. And the long strikes, which is going to cap out the risk at a defined amount at minus 40, show down here. Okay, so now we're going to get into the risk and reward here. So as I mentioned, the reward is about $39,000, close to $40,000. The risk is $40,000. When I compare those, that's close to 1-to-1, right? If I risk $1, I can make $1. That's essentially what this says. Or it says I can risk a little bit more than $1, and I can make a little bit less than $1. All right, but let's call it, 1-to-1. Well, is that good? Is that bad? I mean, what do you do with that? How do I know if this is good or not? Okay, well, this is where that probability factor comes in, that third part of the three-legged stool. So to give this some perspective, a wide butterfly trade constructed in this style, this is pretty par for the course. Okay, this is what you would encounter normally, and we call this an even risk to reward. Okay, that means those numbers are fairly close to each other. It's a 1-to-1 ratio. Now, you're still taking on a fair amount of risk. I mean, we're talking about $40 per contract, right? And that's $4,000 per contract, right? Because you multiply that by 100 multiplier, controlling 100 shares, or just, for the index value and so on. So risk management is important, no doubt, because you can lose just as much as you can make. Well, what was the probability of this trade? Does anyone recall? And, that was 51%. So that says that I have a 51% chance of making money in this trade, and I can make and lose. I have an equal chance of basically making or losing money in this trade. That's what 50% probability says to me. Well, that's basically a coin flip, right? If I flip a coin, I have a 1 out of 2 chance of getting heads. Well, that's not all that attractive to me. But, there are some reasons why someone would do a trade like this. But what I want to get across to you here is to see what those figures boil down to. What does the risk of the trade really mean? What does the reward really mean? What's the probability really mean? Well, what can we do? Can we improve this trade? And the answer is yes. We can improve this trade. And so what we're going to focus on now is we're going to narrow the distance between the strikes, and that's going to cut down on the risk significantly. And you can go over these key points again, but this is just a recap of what the butterfly is trying to do.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.